The health insurance industry had a challenging year in 2014, with the recent downward trend in profitability continuing as returns to surplus fell to 7.9%, down from 11.5% the year before. Although lower than in recent years, that's still not a bad number given the shakeup in insurer operations and consumer behavior caused by the implementation of the Affordable Care Act. But it's likely to be some time yet before regulatory uncertainties resolve and a new equilibrium forms. The industry consolidated combined ratio, or ratio of underwriting expenses to underwriting revenues, increased slightly in 2014, from 98.4 to 99.1, with a slight decline in claims costs more than offset by an increase in administrative expenses. While numerically that seems like a small increase in the ratio, health insurers write a much larger volume of premiums per dollar of surplus than other insurance companies, about 5.5 times as much as the consolidated P&C insurance industry. So even small changes in the combined ratio can have a meaningful impact on the returns to surplus, a concept called underwriting leverage. This leverage increased significantly during 2014 after 4 years of straight declines, as premiums grew faster than surplus during the year. So that small increase in the administrative expense ratio wound up having a sizable impact on the bottom line. Looking at the breakdown of premiums by type of business, we see that the trend of Medicare and Medicaid lines growing to displace comprehensive plans continued. In fact, in 2014, Medicare and Medicaid became the largest source of premiums for the first time on record, rising to 46.7% of the total from 42.8% the year before. This once again reflects the increase of Medicare claims from the aging of the baby boom generation and the ongoing weak labor market increasing Medicaid eligibility. Additionally, the Affordable Care Act allowed states to expand Medicaid eligibility, and many more states are expected to do so. Also, some individuals have only discovered they're eligible for Medicaid after signing up for insurance on the new exchanges, so it's likely this growth trend will continue for the foreseeable future. On the other hand, there are a number of pending court cases that may affect the future of the Affordable Care Act, and the outcome of the 2016 elections may change the outlook for healthcare legislation as well. So we should be careful about extrapolating recent developments too far forward. Investment yields were roughly flat in 2014, which, given the ongoing low rate environment, is about the best that could be hoped for. The gross yield on bond portfolios went from 2.91 to 2.86, a much milder decline than the 30 to 50 basis points it's been falling every year since 2006. The health insurance industry typically invests in relatively short bond maturities due to their high liquidity needs, with only 11% of bonds in maturities longer than 10 years as of year-end. As a result, it seems like the effect of having to reinvest bond proceeds at low rates has pretty well worked its way through the industry's holdings. If so, the good news is that yield declines should continue to be minor going forward. The downside is that if and when yields do rise, it will take time for current holdings to run off and be replaced at the higher yields. Realized capital gains were once again a significant component of pre-tax income as well, coming in at $1.6 billion for the year, the highest since 2009. This was generated by a combination of gains in equity portfolios and also gains on sales of bonds, as interest rates continued to fall, driving prices up. These gains almost perfectly offset the decline in investment income for the year, which helped preserve earnings in the face of rising expenses, but it's hard to say if that will be repeatable in future years, as thus far in 2015, stock and bond markets have struggled to sustain the rapid gains of recent years. Investment returns were also helped by a decline in cash from 28 to 24% of invested assets, which follows a decline from 30% the year before. This has boosted income, but could lead to liquidity pressures in an industry known for its short-duration liabilities and rapidly growing cost of services covered. The health insurance industry continues to underwrite profitably while showing healthy growth of premiums and assets, but declining profitability ratios give some cause for concern. The Affordable Care Act has increased subscriber and premium volume, and over the long term could lead to greater transparency and improved product designs, but in the short term has created significant compliance costs and greatly increased volatility of premiums and earnings. The growth of Medicare and Medicaid, due to a variety of demographic and regulatory changes, continues to be a central theme, though the long-term fiscal profile of these programs makes it hard to evaluate how sustainable this trend will be. Meanwhile, investment portfolio interest rates remain depressed, though stock market gains have helped to offset the loss of interest income. Looking ahead to 2015, health insurers must focus on continuing innovation in underwriting and product design, disciplined investment strategies, prudent expense management, and careful monitoring of the rapidly evolving regulatory environment. Thank you for watching, and if you have any questions about health insurance industry performance, or would like to see statistics for your own company compared to a custom peer group, please contact your portfolio management team if you're a current AAM client, or else contact the AAM Marketing and Business Development Department at 312-263-2900.